U.S. generals, diplomats want Chinese companies out of their retirement plans. Thrift Savings Plan added thousands of new funds, some of which invest in companies linked to China's military. This sounds scary. Kelly Currie has spent much of her government career working on human rights issues with a special focus on Asia. Ms. Currie, who most recently served as U.S. Ambassador at Large for global women's issues during the Trump administration, was unhappy to learn that her retirement dollars could go toward companies that are linked to the Chinese military, the very entities she had been challenging for years. Okay, I guess it depends on the definition of could, because I guess there's the possibility that Ms. Currie could allocate her dollars towards some of these funds that go into Chinese equities and such, but it's not as if the funds will just unknowingly show up there. And well, it's not exactly her quote, so maybe this is the journalist's error or just not quite naming it right. Okay, let's talk about it. My name's Garrett. Welcome to Class 8 Personal Finance. And this is a second video on the thrift savings plan, specifically with the mutual fund window and this whole thing with investigating whether things could go to the Chinese military. Well, here's another one here. House Democrats call for investigation into thrift savings plan website launch. A group of House Democrats would like the Government Accountability Office to examine the rollout of a new website for the $706.9 billion thrift savings plan, Washington, that was mired with issues upon its launch in June. Why did they write it like that? Specifically, the House members request the GAO dig into the planning, contract, award, and implementation, as well as oversight by the Federal Retirement Thrift Investment Board of the website launch, said all these people. So there's been this website launch. It launched about May 26th or so, and the website has been a problem for a lot of folks not being able to log in, etc. So if this is news to you and you are a TSP participant, current or former federal employee with a TSP account, you probably want to get in there because you are going to have to establish a new login. And if you haven't, then some other clown could potentially go in and do it him or herself. So you want to do this as soon as you can, if it even lets you do it in the first place. It's probably not news to you now, but there you go. But in this video, I want to talk specifically about this China issue and the mutual fund window, what you can do, what you can't do, and go from there. When you go into the mutual fund window, when you navigate through the TSP and all that, you get to this right here. Maybe I should block out my part of my account number when I publish it, before I publish this to YouTube or whatnot. But you'll see this, and then you can go to Tools here and then Fund Screener, and it'll show you the list of funds. So I'm going to pull this up for a moment. But first off, I'm going to talk about the mutual fund window and reasons why you should go into it or should not go into it. That is ugly and shouldn't have been part of the video. That's okay. So there are some prerequisites to using this mutual fund window. One is that you have to have a $40,000 account minimum, because you can only have up to 25% maximum in the mutual fund window, and the minimum is $10,000. So do the math, you need $40,000 in the account in the first place. So if you're just brand new to the military, brand new to working for the federal government, this isn't going to be your thing for a while, and it wouldn't be a good idea anyway. Here's another prerequisite. You have, and this is not a technical prerequisite, you have a significant amount of money already in the TSP, or you strongly desire to keep everything in one account in your TSP. If you want to have the flexibility of doing some other investments, you always have the option of doing a Roth IRA or traditional IRA, where you can find some other things there. And those are both easier ways to do it than through the thrift savings plan mutual fund window. But if you want to keep everything in one account, you might want to go with this. And then also, you need to make sure that you're comfortable screening mutual funds separately from the TSP provided tools. And we'll look at this in a bit. There are some reasons not to bother with this. One is that this looks pretty complicated. Almost nobody really needs this in terms of the amount of complexity that you're adding to this. And finally, the fees are pretty expensive. There is, you know what? Let's look at. No, I'm not gonna look it up right now, but there's a per trade fee, and I want to say it's somewhere just below $30, and there's a $150 annual fee that comes with this in order to use the mutual fund window, and that's going to be on top of any of the expense ratios that you have in these funds. When you look at these funds, I'm going to rip on this screener for a moment, because if you understand the thrift savings plan, let's look up the thrift savings plan funds for a moment. TSP funds, because I can explain these just shortly. I did this in the previous video, so I'm just going to make this really, really fast. That compare up to 3 funds. Your interface stinks. Okay, so I'm just going to talk about I'm just going to have to talk about all 5 funds here from here. So you have the G fund, which is your government securities investment fund, and it's basically a really safe treasury fund, treasury bonds, and it doesn't go down. It's almost like a savings account on steroids, but the rate of return is the average of all the existing U.S. Treasury bonds greater than 1 year in remaining maturity. The F fund is basically a bond market index fund. It's a combination of treasuries and corporates. C fund is an S&P 500 index fund, so you're talking about large cap U.S. stocks. You have an S fund. Let's just go to stocks here. Among stocks, you have a C fund, which is large cap, large company U.S. stocks. S fund, which is basically what they call the S&P completion index. I guess it's called the Dow Jones U.S. Completion Index now, but it's basically stocks that are smaller than the S&P 500 on the U.S. market. And then you have the I fund, and then note here it says match the performance of the MSCI EAFE index. And you'll note what EAFE stands for. It's Europe, Australasia, and Far East. Now, these are only developed markets countries, not emerging markets countries such as China and Taiwan. And it's only in Europe, Australasia, and Far East, so it also excludes Canada. And according to MSCI, not according to another index provider, South Korea is South Korea is an emerging market, not a developed market. So this also excludes South Korea. So if you've done any sort of diplomacy, any sort of work in the Far East like I have, imagine telling the South Koreans that the U.S. service personnel are prohibited from investing in their retirement accounts in South Korean stocks, but Japanese stocks are totally okay because they're within the EAFE index. Yeah, okay. But suppose you want to diversify out of these 3. So here are some reasons you might want to do the mutual fund window. Or rather, let's talk about the screener for a moment. We'll get to what I just said later on. You have this screener tool here, and the first thing it wants to tell you is sustainability. Don't screen by sustainability. I could go on about how this isn't such a great idea, but if you care about it, if you care about sustainability, hey, great. But that has to be your own estimation of whether you want to reduce your ESG risk, your exposure to risk associated with being bad at environmental, social, or corporate governance issues. But I don't think that should drive the entire portfolio. Maybe you have a different view and you want to do that. Okay, great. But I just don't think you should do that just by highest sustainability rating. You should probably dig into what the holdings are and understand what's going on. My previous video was on Christian-based mutual funds and the reasons why you need to go into the holdings, because sometimes those holdings might not be things that you want in there. Morningstar rating, just ignore. And I'll explain this in a moment. Lowest fees, good thing to pay attention to. So for example, you have prospectus net expense ratio here. So Fidelity Total Market Index, I think, is a great fund. And it's got an expense ratio of 0.02%. That's really cheap. If you flip this around, let's see what the most expensive is. Can I flip it? Yes. The most expensive will take 4.16% of your investment every year. That's absolutely ridiculous. Why is it even in here? Well, probably because the provider of this mutual fund list and all that TSP contracted with basically said, hey, here's your list or something like that. If there had been some sort of screening, then you wouldn't have a bunch of China funds in there. We'll talk about that in a moment. Definitely pay attention to expenses, and we'll talk about that as we go through this. Now, I mentioned these individual funds here because there's a whole lot of reproduction going on, such that things that you could do just with these are also in here. And if that's what you're going to do, then you don't need to pay the $150 a year and the $30, whatever it is, trading fee per trade to get your funds actually into here in the first place. So, for example, Fidelity Total Market Index. Yeah, it's a great fund, but you already have the C fund and the S fund. And if you put those in an 80-20 ratio, you're doing the same thing. So why would you go into the mutual fund window for that? Why does it need to be there in the first place? They're making things way too complex. S&P 500 index for Schwab. That is the C fund. Now, Schwab doesn't run the C fund, but it's an S&P 500 fund. Why is that there? Same for State Street Equity 500. I'm going to guess that's an S&P 500 index fund. That's a pretty safe bet. Okay, I'm sure it's a great S&P 500 fund, but you already have the C fund, that kind of thing. So that is frustrating to me because you should try to make things simple. And the normal TSP funds do a good job of doing that. And if you're going to show, this whole list of funds, at least screen them down such that you're not reproducing things that are already available in the normal funds. But what are some potentially good reasons to go into that? And I'm going to go through 3 of them. One of them is to mess with the bond allocation. So as I already pointed out, there are 2 bond funds within the normal TSP funds. And these are the G fund and the F fund. I like the G fund. 90% of my bonds are in the G fund, and I'm happy with it. 10% the other 10% is not the F fund. The F fund is a mix of treasuries and corporates, rather in the G fund is just treasuries. But the issue here is that the F fund is a mixture of treasuries that aren't as good as the G fund ones. So you got a mixture of short-term, intermediate-term, and long-term treasury bonds that still have the duration risk. Those treasuries can still go up and down. So here's my question. Why is the F fund a mixture of these treasuries and corporates when they could have just done a corporate bond fund? You could have just done the G fund plus corporate bonds, and then you wouldn't have had it diluted by these treasury bonds that are completely inferior to the ones in the G fund. That decision doesn't make any sense to me, except for those folks who just want to go with the F fund only or something like that. It would have made more sense to have a G fund with the G fund bonds and an F fund. F stands for fixed income, by the way. And have that just be the corporate bonds and maybe choose a different letter that's not C because C is already taken. You get the idea. So what could you do differently with this? Here's one idea, and that is high yield bonds. A lot of folks are going to maybe throw some rocks at me if they're watching this video, depending on how much audience I get. I don't get that many views. But here, what I do is I put 10% of my bonds in high yield and the 90% in the G fund. And the reason for that is to chase a little yield while still benefiting from the safety of the G fund. So for example, I wonder if you can actually see this in the Morningstar category. See China region on there? That's awkward. Let's see if I can find high yield bond and then, yeah, you can actually see that. When I did the research for this video, I just typed in high yield and went on from there. And so as long as you have this sorted by the net expense ratio, and you should, then you can see what the cheapest ones are. And just looking at this, the only one that I would really look at among this list is the Vanguard High Yield Corporate Bond Fund, Once you get to American funds triggers me in terms of their normal expense ratios. 0.30 isn't terrible, but it could be better. 0.13, a lot better. And then what you can do is click this. Click this, and you'll get, wait for it, it's loading. It's loading. It loaded faster than this last time. It stopped loading. You get absolutely nothing. You get this blank white page, and then securities offered by Alight Financial Solutions. Thanks, guys. You're awesome. It did the same thing to me last time. My ad blocker was already off, and it just doesn't show anything, and that's stupid. So what you need to do here is take this ticker right here, VWEAX, and just search for it, VWEAX. And then two things you should look at. One, go ahead and look at the Morningstar page. So I'm just going to open up a new tab for that. And then make sure you get the information from the horse's mouth. In this case, it's a Vanguard fund. Find the Vanguard link for this and click that. So on Morningstar, you can see the rating actually changed. I'm seeing this just like you're seeing it. No, I'm wrong. This is 4 stars already. Never mind. Okay, I'm wrong. So here you can still see the expense ratio is 1.30, and go straight to portfolio right here. Whenever I'm recording, these things load a lot more slowly than I would like. It's just the reality of it. Maybe if I switch to Max, it wouldn't do that, like Macintosh. So you can see the fixed income style is limited duration risk, but low quality. So in the event of a crash, these could potentially do pretty badly, but they'll pay you a lot of yield as long as things are normal. And so I still wouldn't go more than 10% of your bonds in this if you're even going to pursue something like this in the first place. I do something like this, but I use ETFs within a Roth IRA. So I'm only talking about the mutual fund window because of the whole TSP context that we're doing this in. Again, don't use this as your entire bond allocation. Limit it to 10%, I would say, of your bonds. But you'll be able to chase some higher yields that way. And since the Vanguard fund is 0.13%, you can verify that on the Vanguard website. You'll pay less in expenses than all those other high yield bond funds. If we go down here, you can see the number of bonds is 629. Average duration is 4.3 years. Duration is the best measure. If you need to look at one measure of duration risk, of interest rate risk. Basically, if interest rates go up, values of bonds tend to go down. And so 4.3 years is, you can think of it as like a 4.3-year bond. Here, the duration risk, they actually put medium, whereas Morningstar put it short for some reason. And then you can see the ratings of these bonds. And yeah, these are pretty low rated bonds, which is why you should limit your investment to them at all. You don't need this, by the way. You could just go straight G fund and not do high yield bonds, and you could do just fine. So it's just an idea to throw out there. And finally, you want to look at the holdings, and you'll see, note these are coupon rates, not the percentage of companies that are in there. But you can see the types of companies there. Sprint. I'm trying to look at other Frontier Communications, Nokia, and then you can go to the next page. I don't like Vanguard's new interface with this. Ford Motor Company, they've been struggling as of late, that kind of thing. So there's still a lot of companies here. So you have diversification in terms of the number of companies that are here, but they all are exposed to the same risk of, if the whole economy goes down, these are going to be more at risk. And that's why the compensation is there in terms of the rates that these bonds pay. So you could consider something like this. The ETF that I use is USHY from iShares. on the ETF side. That's how I have 10% of my bonds in high yield, but definitely limit that. Don't go all the way and go, oh, I'm all in high yield bonds and then bonds are safe. No, that's not how it works. All right, so that's one idea to use. Another idea to mess with your bond allocation is Treasury inflation protected securities. Yes, I'm still here. It puts that warning out there even though I'm clicking around because I haven't bought anything, and it's really annoying. So maybe inflation protected bond is in Morningstar category, and indeed it is. And the Morningstar category is so long right here that it kind of blends into those expense ratios. And so you can see Fidelity, Schwab, iShares, Vanguard, and Vanguard again all have these inflation protected securities funds that are 0.10% in expense ratio or less. DFA is a good company. This isn't going to be an index fund, but they do a good job with their actively managed funds. They are very index-like, and they do some things to try to beat the market. I'm not familiar with this fund, so I'm not going to say I've fully endorse it, but I would take a look at it. Just for kicks, let's look at, let's make some differentiations here. Here's what I'm going to do. I'm going to take the Schwab one for a moment, SWRSX, and I'm going to search for that in this tab here. And we're just going to open up the Schwab one. And then I'm going to open up another one here. And this here for iShares is a short-term TIPS bond fund. Probably short-term TIPS might not be something you want in an investment account, but let's see. I want to see what we have here because I didn't do the whole research here. You can see the expense ratio is 0.05, which is a great, cheap fund. You can see the weight effective duration for this fund is 6.9 years. That might be too long if you're concerned about interest rates going up. And then let's go to BlackRock's website here for this iShares fund. I find this a little strange because I thought iShares was BlackRock's branding. No cookies. I thought iShares was solely BlackRock's branding for their ETFs, and this is saying iShares short-term TIPS bond fund, and it's clearly a mutual fund because the ticker ends in X. But you can scroll down here. Where is the duration? The effective duration here is 2.68 years. And so you're exposed to less duration risk, less interest rate risk, but it's not going to pay you as much. And if you look at the SEC yield right here, this is showing 6.80. What's going on? I guess that makes sense. That seems pretty high. And then look at the SEC yield for the Schwab fund. Yeah, okay. So there you go. 13 point. I guess that makes sense because of the way inflation's been. The SEC yield for that SEC yield is basically what the bonds have been yielding over the past 30 days. And there's a standard formulation that the SEC, Securities and Exchange Commission, mandates so that the funds don't come up with their own little formulas to try to one-up each other and make the yields look higher than they actually are. That way, it's at least an objective standard. You look at the SEC yields from two different fund providers, and they're using the same formula, and you can be objective with that. So this is 6.80 for the SEC yield. This is 13.46. You shouldn't expect that to be like the whole return. Inflation rates are kind of messing with this formula, but you can see that when you take more duration risk, you get more SEC yield. So you have to kind of weigh that and figure out what you want to do. So that's a second thing that you could do to mess with the bond allocation. A second thing you could do, another reason to mess with the mutual fund window is to mess with the international allocation. So as I was showing you earlier, let's see if I can get the correct tab for this because I want to go back to the TSP funds list. That's okay. So you remember when I was talking about the I fund, and the I fund is the normal TSP international fund, and it's based on this MSCI EFI index, Europe, Australasia, Far East, EAFE. One thing you could do is just completely ignore the I fund and just stick it into use the mutual fund window to do your international allocation. But this comes up with the China issue. So let's talk about that for a moment. You shouldn't expect the TSP board, the Federal Retirement Threat Investment Board, mouthful, to suddenly change the index of the I fund to something that has China, because they already tried to do it before during the Trump administration, and there was enough political force to keep them from doing that. So the concern of this lady saying she's unhappy to learn that her retirement dollars could go toward Chinese military-linked companies, as if they're going to do it without her knowing. Not so much of a concern, but it is something that you could potentially do and potentially not know about unless you're careful, if that's a concern for you. It is a concern for me. I stay out of China funds completely. But let's talk about this. If you go here and you go to, say, it's probably going to be under F, under foreign. That's the way they go in. So let's say foreign large blend is probably where we're going to start here. And you can see Fidelity International Index, for example. iShares, MSCI, EFI. Okay, why would you do that? Why is this here? The I fund already tracks the same index. Why do you offer this in the mutual fund window? Who's running this? Okay. Fidelity Global XUS Index. What's the difference between those two? How do you figure this out? Well, again, you got to look at the ticker and you've got to look at the holdings. So, for example, FSPSX. Let's copy this and see what we get. Let's close out some tabs here. Well, there's that tab. I'm a moron. So you click on iFund, you see MSCI EFI. That's what I was going to show you. But let's move on from that. And I'm going to type in opens a new window, FSPSX. Okay, I just copied too much. So let's look at the Fidelity page and see what we get. I don't need the Morningstar page for this one this time. So Fidelity International Index Fund, it's still got an expense ratio of 0.035, which is great. And then I'm looking for the index. The index that it tracks is what? Maybe go to composition here. Is that going to show me? I used to be able to find this a lot faster. Come on. I don't edit these things, so I got to know. It looks like MSCI EFI. Yeah. So it's an MSCI EFI fund. It's the same as the I fund. So why is it there? Do you see how much time this thing is wasting? Okay, let's try again. EFI, TIAA Craft International Equity Index. I just don't like that company. Fidelity Global XUS Index. I think this could be a good objective illustration. Let's see. Open the new window. Okay. FSGGX. All right. So let's see which index this one tracks. Fidelity's website doesn't make this easy, to be honest. Expense ratio 0.055, which is still good. And I'm going to go down there. Okay, now you look at the top 10 holdings and you see the first is Taiwan Semiconductor. Okay, not China, not People's Republic of China, Republic of China, fine. Nestle, I guess, SA. Tencent, that's a Chinese company. Roche, that is Swiss, I want to say. It's in Europe. Alibaba, People's Republic of China. Samsung Electronics, South Korea. AstraZeneca, UK. Shell PLC is now a UK-only company. It used to be British and Dutch, but you get the idea. So definitely there's some China in here. And normally investing at least 80% securities included in the MSCI All Country World Index ex-USA index. So basically, all the countries with stock markets, all developed markets and emerging markets, probably not frontier markets, excluding the United States. So it's going to have Canada in there. It's going to have South Korea in there. It's going to have Taiwan in there. It's going to have China in there. So the name of the fund doesn't necessarily have to say China, like when you saw China region in the categories, in order to have some China in there. And that's a matter of your own conscience. I keep out of it. It's partially a conscience issue for me, but it's also that I don't believe the market properly calculates political risk. And I believe that to such an extent that I'm actually underweight Taiwan as well. As much as I say, hey, Taiwan is a country, we're going to defend them, etc. From an investing standpoint, I'm actually underweight there because I don't think the market is properly calculating the political risk of China doing something really stupid and evil. So that's, again, when you research these funds, you've got to look at the tickers. The one I'm going to point out as the thing to get is VTMGX. This is Vanguard's Developed Markets Index. And as far as just straight international index funds, not ones that are targeting factors or whatnot, this is the one I like. I don't invest in it in myself because I still use TSP's iFund, and then I supplement it with a Canada fund, a South Korea fund, a Chile fund, an Indonesia fund. I've got all these individual country ETFs that I supplement it with in order to build the international portfolio that I want, and you can't do that in the mutual fund window. You definitely wouldn't want to. But you go to Vanguard's VTMGX, Developed Markets Index, and there's a reason I like this more than the MSCI EFI Index. Well, welcome to recording session number 3. My microphone froze at the end of recording session number 1 there, and I stuttered on the introduction to number 2. So here's number 3. We're still talking about the Vanguard Developed Markets Index Fund. It's VTMGX. If you want the ETF for this outside of TSP, it would be VEA. That would be your ticker symbol. But this one is not based on the MSCI EFI index. It's not even based on an MSCI index at all. It's based on a FTSE index, FTSE, and that stands for Financial Times London Stock Exchange. Where did the L go? I don't know. But FTSE, FTSE. No one calls it FTSE verbally. But go down here to the countries that it tracks. Remember about the EFI index, Europe, Australasia, Far East. Canada is in none of those regions, but it's within this index, which is great. And note, it's 10.5% of the developed markets in the world. So why would you want to, not include Canada? It defies logic that the iFund would track the EFI index, really, because there are better indexes out there. There's a better index from MSCI, too. Note that it has Korea. According to MSCI, Korea is an emerging market, and so despite it being in the Far East, it's excluded from that EFI index. It's here in the FTSE Developed Markets Index. Hong Kong, sadly, is not a free country anymore, but the indexes haven't responded to that issue. Less importantly, because it's only 0.20%, Poland is in there. So there's more diversification here in this Vanguard fund. And so if you're considering going into the mutual fund window and you're looking for a reason, or rather vice versa, it's like, hey, is there a reason to even go into this mutual fund window in the first place? I would say using this as your international allocation rather than the iFund, or at least include as much of this as possible in addition to just putting the rest of your international allocation in the iFund. This is a good way to go. Let's talk a moment about things to watch out for with the international allocation, because I think I talked about a couple things when my microphone froze and before I realized what was going on. One thing, and there's the evidence right there. I'm going to kill the search right here. So obviously, if you select China region in your fund screener, you're going to get a bunch of China funds, and they're not talking about the Republic of China. They're talking about the People's Republic of China. But the other thing, and I didn't see emerging markets stock among the Morningstar categories, and I'm just not going to, try to scroll through there. It's a terrible interface. But I can click here and go emerging markets right there, and you'll get all these emerging markets fund. For some reason, the developed markets fund shows up first, and it's not emerging markets. I don't know what's so emerging about it, but it shows up anyway for you. Here's why. I guess the Morningstar category is called diversified emerging markets. Let's just do that. Diversified emerging markets. That's what it's called. And you'll come up with all of these funds. All of these emerging markets index funds are going to be about 33% People's Republic of China. So a lot of folks would tell you, hey, you can diversify into emerging markets by taking the TSP I fund, and you add an emerging markets fund to that, maybe in like an 80-20 ratio or something like that. That's not something I'm going to recommend, because I just don't recommend going into the People's Republic of China in the first place. I don't think the market properly calculates political risk. I've been, quote unquote, right since the time I made that call. And, it may be that I'm really, really smart about political risk. Maybe I'm just lucky. Who knows? But, yeah, I just don't recommend using emerging markets funds in general unless they're screening China out. There are ETFs that screen China out of emerging markets and then go everywhere else. And maybe I'll make a video about that at some point. I alluded to it when I did a video on international investing earlier outside of the TSP context. Okay, so leaving the international side, another reason why you might want to go into the mutual fund window is to mess with factors. So earlier in another video, I talked about factor investing. And so in addition to what we call the market factor, which is what you're getting with something like a total stock market index fund, or even an S&P 500 index fund, it's basically, you're talking about the whole US market. There's other factors that explain stock market returns, and those are stock size, for example, small cap stocks. You're talking about value. So it's about stocks that have lower prices relative to their fundamentals, such as price to book value or price to earnings. There's profitability. There's two different types of profitability, but we're just going to call it profitability. Sometimes you might see it referred to as quality, which is a little bit different, but targeting basically the same logical idea. And then there's investment. Investment is basically how much that company invests in new projects versus just returning cash to shareholders. Low investment tends to involve better returns. It explains more stock returns. So if you want to target factors within your TSP, that's difficult to do within these normal TSP funds. So if I'm going to pull up CS and I here. So you're looking at this, okay, yes, there's a small cap stock investment fund, but it's not very, very small. Really, you're talking about everything that's not large. So you're talking about a large portion of mid cap stocks here in addition to small cap. And you want to go smaller than this if you're really targeting factors. You could, in theory, overweight the S fund. Instead of an 80-20 ratio, you could go with 70-30, 60-40, 50-50. But that's not really targeting factors all that well. So if you want to do this within your mutual fund window without involving a Roth IRA, for example, you could go into a Roth IRA and use small cap funds when there. If you want to do this within your TSP because you're just trying to keep it within the same account, you could target small cap value within your mutual fund window account. So how do you find these? Let's clear out the Morningstar category here, and we can go to, let's go to small value. And when you click small value here, you're only going to get the US ones. They're not going to show you the international ones. Again, sorted by net expense ratio. You can see Fidelity Small Cap Value Index, Vanguard Small Cap Value Index, etc. So you have these index funds that target small cap value, but they're not going to target profitability. They're not going to target or quality. They're not going to target investment. And the disadvantage with index funds in this context is that the indexes can be front run. And so I would actually recommend going towards something like DFA US small cap value. So you can look up DFSVX. Yes, the expense ratio is higher. I think this is going to do better in the long run. And note, this is not one I invest in. I do invest in some dimensional funds, but not this one in particular. I use an Avantis fund for my US small cap value, and that's not in here on the US side. But you can still look at those index funds. And in fact, let me show you a comparison. So I'm going to compare VSIAX. I'm actually going to use Morningstar for this. Let's see, Morningstar. We'll just do quote for now, but we're going to click immediately over to portfolio once we get to that page. So it still shows that the investment style is small value. Keep it coming. Load for me. Okay, so note where this blue dot is relatively. Then when you look at the weights, note these numbers, and let's note the number 28 here. So I'm kind of going off a limb here, going off a little bit of faith to see if I look right on this. Now, I'm still here. I have been clicking you. DFSVX, and let's just duplicate this tab here, and then let's see if this works. DFSVX, type with one hand, all fancy. Hopefully that's NASDAQ listed also. It is. So DFA, Dimensional Fund Advisors, US small cap value. And we're going to hope this loads well. And I hope I'm right. I hope I can show you. Yep, there you go. So if we put these side by side, yeah, come like that. So on the left, we have the Vanguard fund. And note the weight here. So this is the dimensional fund over here on the right. Let's do this. Then on the left, we've got where to go. Oh dear. There we go. Let's minimize that. So we've got the Vanguard fund on the left here. We've got the dimensional fund on the right here. And note how much more small value it is. Is the Vanguard fund technically small value? Yeah. And it's tracking an index that just tracks a lot more of this, whereas the dimensional fund is not technically an index fund. It's index-like. But they are doing some other things that I'm not going to try to explain. But it's a lot more small and a lot more value-y, if that's a word. When you interact with the factor investing community, you'll hear value-y a lot. And note the difference in position of these two blue dots. The blue dots are the ones that actually reflect what the funds are doing, vice the small value categories. And note that the yellow ones are the same spots. And then Morningstar, US small value. So the red dots are the same. The yellow dots are the same, but the blue dots are different. The blue dots are actually what these mutual funds are doing. And the DFA fund is a lot more down there. So if you're really targeting these other factors, you want something that's concentrated. And that's what the DFA fund does for you. Yes, it is more expensive to do that. So you may make the call and say, hey, look, I just want the smaller fee to do that. Okay, great. As long as you know what's going on with that. But I would say if you want to target small value using the mutual fund window, you want the concentration. So that's the US factor side. Let's talk about the international side. I am going to get that bag away from my screen. And we're going to, let me just use this window to pull up the name of the fund. Because AVDVX is what I'm going to be talking about with this one. And I'm just going to I'm just going to pull up. I don't think Vanguard has a small cap value index fund that's on the international side. So let me just pull up this one. And if I open up the other window here, let me just combine these two again. There we go. And bring this back up. I think we got this. Okay. So AVDV, I wanted AVDVX because of the ETF. I own this one. Full disclosure. There's also AVDVX, which is the institutional mutual fund, but it is available to investors within the TSP. Note that the investment style, according to Morningstar, is mid-value, but that tends to be that's a tendency with these international small cap value funds is they are listed as mid cap value because of what's available on the international market. Let's go to here, and I'm going to change the Morningstar category and find, it's called foreign small value in this context. Foreign small / mid value. So note the struggle to actually find foreign small / mid value. And you'll see right here, DFA International Vector Equity is more of a blend of small and mid and large, I guess. Avantis is the one that I'm pointing out. And here's something to watch out for. Sometimes you'll see IDX or index and go, oh, it's an index fund. Well, technically, yes, but it's an actively managed index. Like, it's not actually market cap weighted within that category. They're doing some other stuff. I'm not saying it's a bad fund, but no, it's when you see fundamental index, it's not a normal index. There are some Schwab funds that track what are called RAFI indexes, RAFI, and those are basically, they make an index based off what they read as the fundamentals. They're not necessarily bad funds. I've invested in them before, but they're not normal or true index funds. And then you have here DFA International Small Cap Value. So let's pull that one up also. Yeah, so that is what I was going to do. SVX. Not Walt Disney. International Small Cap Value. That's what I wanted. Okay. And then we're going to... Can I squish this up without messing up my video? Yeah, I guess I can. And then we're going to go to portfolio on this side. Oh, no, don't do that. Did I hit 7 days free? Hope not. Okay. So note the stock style while we're loading for the waiting for the dimensional side to load. You can see that this is like on the line between small and mid, whereas the dimensional fund is more value-y and smaller. What's going on there? Avantis is a relatively new outfit. It comes from a few guys who broke off from Dimensional Fund Advisors. And there's like a public story of how that happened. And perhaps there is a private story of why these guys disagreed with what Dimensional was doing and decided to go do their own thing. Ah, ha, ha, ha. Perhaps we'll never know the full truth out here in the public, and perhaps it's not my business. But you can see that Avantis is a little bigger and a little less value-y. And the reason for that is they have a stronger emphasis on profitability. And when you do that, you're going to have stocks that are growthier. So that's what's going on there. I think both of these are fine choices, but you'll want to know that if you want to target international small cap value. So if you're going to do a route like this, you might, for example, take that 25% and do half of it in US small cap value and half of it in foreign small cap value. And so you could accomplish that with two dimensional funds, the DFSVX that I mentioned on the US side. And then on the international side, you have a choice between the dimensional fund and the Avantis fund. Again, I happen to invest on the Avantis side more than the DFA side, but I do have some DFA funds, and I would still trust both companies. Now, you might be asking, okay, well, why not do Avantis on the US side? Isn't there an Avantis US small cap value fund? There is. It just doesn't happen to be within the mutual fund window for some reason. It's weird. So you go to this investor portal. Let me just clear out the categories here. I just click reset, huh? And then I just type in Avantis. And that's it. Right there. It's only the international small cap value that they had, and no one's really sure why that's the case. Oh well. So just reviewing. Do you need the mutual fund window? No. Are there better ways to mess with your portfolio if the TSP is your main thing? Yes, you could go with a Roth IRA, and then you have the full flexibility to do all kinds of targeting within ETFs, and then have your normal thing going on within your TSP. But if you want to have this all in one account, you don't want to deal with multiple providers or something like that, then you could use this mutual fund window, and you'll have to pay some fees in order to do that, but it is a way to get that done. The other thing that I'll point out, because I'm a Navy veteran, is perhaps website access to websites like Fidelity or Vanguard or Schwab perhaps might be limited, because I remember the IT folks had a problem with people doing day trading on the ship, underway, etc., because it's taking up traffic and all that. And so they would say, hey, stop day trading. Well, if you have a Fidelity brokerage account, then maybe they think you're day trading, even though you're just in a conservative list of ETFs and you're not, messing with things strongly. And especially with ETFs, where you have to trade them during the day, and the day might not be the day when you're out overseas or something, you're trying to figure out time zones and you just want to deal only with mutual funds, then maybe going with the TSP website really is the smartest thing to do, because of your own personal logistical situation with where you're serving and how all that goes. So that just came to mind because I've been helping someone who's about to ship out to where I used to serve in Japan. And, so using the mutual fund window in a situation like that might be a good idea, assuming you have enough to actually put in there. Again, you need a $40,000 account minimum. You can only put up to 25% of your account balance in there at a time, or, at all, basically. I don't know what happens if the mutual fund window grows past that 25%, if they just make you take some out, or, they just let it grow in there and not let you add anymore or something like that. And then you still have those fees that you're talking about. I think it's like a $150 annual fee plus whatever trades you're doing. It's just under $30 per trade. So you're only going to want to do that once a year max per fund, and only one or two funds, something like that. And on top of that, you're still going to have the expense ratio associated with that. So for example, the expense ratio on this Avantis fund is 0.36. So you're going to have to pay that as well. That's going to be pretty opaque. It's just, money that's just not going to show up. You're not going to see a fee taken out of that. Reasons you might want to mess with the mutual fund window: one is messing with the bond allocation, two, messing with the international funds, and three, messing with factors. US small value, foreign small value. That's how that goes. So let me know in the comments if you have any questions, concerns, complaints, or verbal abuse. My name is Garrett for Class 8 Personal Finance. Thank you for watching, and I'll see you in the next video.